Good evening, everyone. Welcome to yet another episode on Law and Order. We spoke last week with regards to the stock exchange and gave you the basics of what really happens there, how trading is done, how you could enroll into trading on the platform, how you could get in touch with your brokers and what to buy and how you could do so. But there are lots and lots of things that happen in the stock exchange that you probably might not know much about. So to talk more about it and get inside information as to how you could keep away from getting into trouble with your investments, we do have with us a prominent lawyer, the sector specialist in the Ministry of Justice for commercial law reforms, and also the regional representative of the International Chamber of Commerce, the YAF. We do have with us Mr. Nishan Sydney Premitharatna. A very good evening to you,
Good
Nishan.
evening, Ishan. Thank you very much. It's a pleasure and an honor to be here in the program.
We spoke about the stock exchange at large, Nishan, last week, and moving on to how and what really happens there with regards to investments. How viable is it for anyone out there to go and invest in the stock exchange?
Well, as I mentioned at the last week's discussion we had, it's a very easy thing to open the account. So once you open the account and you start investing, the beauty about buying shares is that you can liquidate them also very quickly. You buy a car or you buy a land, it might appreciate, but liquidating, selling it, making it into cash takes a lot of time. Generally in the stock market, it's very easy. Within 3 days you decide to sell your share, you are entitled to get your money. But the question is ultimately investor confidence. You don't want to be investing or taking in 5 million rupees into the market and suddenly overnight it has dropped down to 4 million rupees and your total overall value drops. So then serious question marks would come into you and you wouldn't know what to do, whether it's going to go up, how, because if you liquidate it, you're only going to get 4 million for something you paid 5 million, and that has happened overnight. So that sort of fear is something which we have to be able to eradicate from our market. We need to be sending the proper signals. We need to be able to attract investors from not merely Sri Lanka and not merely senior citizens of our country who have been investing in fixed deposits, who now feel it's the time to be investing in the market because the revenue or the generation of profits are seemingly higher. We have to be able to capture investors from a global context. So how are we going to do that? How are we going to bring in investor confidence? We have seen the Sri Lankan market going up during the last 3-4 months significantly. Record heights, as you mentioned the last week, have been reached, but these record heights can come down also to record lows. So we have to be very careful. So the regulators, the SEC, the CSE, they all try to ensure that they continuously monitor the market. So but as an investor, I would personally feel that, as I mentioned the earlier time, if you buy shares on fundamental principles, you buy shares of good companies which you feel are good. The company has been doing well, its track record is well, its net asset value is high, and you are buying the share possibly at a lower market value, that is seemingly a prudent investment. So even if your 5 million investment comes down to 4 million within a period of 2 to 3 days, because it works on demand and supply. You buy a kilo of carrot, that might be 350 on one day, and on 2 days time you can buy it for 200 rupees. So it works on that. But carrots and the benefits of carrots, it will be there forever. So like that, you have to be able to understand and make informed decisions when you invest. But if you do that, you can make significant capital gains over a long period of time.
And that's something a lot of people needs to know. It's not about in the short term, but a lot of people do get involved to make money in the short term. But what we have seen is, Nishan, something that a lot of people talk about is the fluctuation in the share price on certain companies. Say, can a price of a particular company, a company, I would say, a share price could be inflated artificially?
Yes, it is done. Unfortunately, it's a known fact that in our market, seemingly stories also drive share prices up. So the speculation that something is going to happen, some project is going to come to some company, and that being spread within the key stakeholders in the market, and they promoting that to the end investor entails everyone boarding that share. So then the share starts going up. So then, however, there is no fundamental basis, it's purely on speculation, whether a certain company gets some license which is going to bring in significant growth for a long period of time. But with that uncertainty, merely on the speculation that it is going to happen, people are required to come, they go and buy the share. Then that doesn't transpire. So when it doesn't transpire, everybody starts dumping the share. It's called dumping, is selling the share. They don't care about it, they didn't know why they bought it, then they sell it, then it definitely comes down. So there are no fundamentals in that company, unfortunately, then to hold the share value. Obviously, it has satisfied the minimum requirements for it to be listed, but that does not mean that it can maintain that inflated, artificially generated share price for a long period of time. So when it comes down, if you unfortunately were one of the persons who bought it at the higher price, you are at a very dangerous plight. So, however, we have to mention that the SEC and all of these, SEC and even the CSE are very mindful when shares go up in price. So they compel the board to disclose any reasoning why. Is there any commercially sensitive or price sensitive information which you are not disclosing to us? So then if that is put forward to the company and the company makes a public announcement, immediately they have to do so. Then any investor can get some form of idea that there is no, that speculation is merely speculation. You don't need to buy. Yes, then you can then retract from that investment opportunity. So that is one way. So you have to always be careful, be mindful. It is your hard-earned money. When you go into the stock market, laws are there, but ultimately greed can also set in. So greed, when you see a share going up from about 200% over a period of about 2 months, you feel, why not I have also part of the pie, and that investment thinking should be completely retracted from.
And Nishan, you mentioned about how this could be done, and it is unfortunately happening in the market, artificially inflated prices. In a situation where you get negatively impacted, what could an investor do at that very moment?
So that's a very, it's a question which seemingly, unfortunately, if you go and buy a share which is going up and you don't understand why it is going up and you're buying it on speculation, there is significant risk that you will be stuck with that investment for a significant period of time. That fingers crossed, the company, whatever the speculation can transpire over a period of time, and then the share can recover and go up to a certain degree where you can sell and exit and minimize your losses. Otherwise, you might have to, so generally a person who trades on a day-to-day basis only might get stuck with that sort of a plight. But if you are a long-term investor, you buy your shares, you just close you don't need to go on your app, and in about 6 months you open your share portfolio and have a look to see where you have gone. That might be, there are investors in that nature. They do not worry about the market on a day-to-day basis. But the fact of the matter was, during the last 2-3 months, everybody started being on the market and continuously monitoring the market on their app. So they were doing that because the market was giving them rewards. So you have to be circumspect. You have to know what you're doing. You should not merely buy because your broker tells you to buy. This share is going up, why not you buy that? That is a deadly affair.
Right. We're going to move into something interesting, something a lot of people talk about, but not a lot of people understand. What is insider trading?
So that is simply where, say I am privy to certain commercially sensitive information in respect of a company. So say now I am a director, or I am a director of a company, and I am aware that the company is going to issue bonus shares or split its existing shares, and that announcement is going to take place at the board meeting tomorrow morning. So in such a situation, if I start buying the shares of that company, I might not be, as a director, if I buy the shares of a company which I am a director on, I have to disclose that. that disclosure goes to the market. So, even if a director starts selling shares owned in a certain company, that disclosure is given to the public at large. So, the public can try to gather why a director is buying or why a director is selling shares. So, generally if a director is buying shares in a company, you feel good. You feel that the director is doing that because the director also believes the company is going to do well. But if a director is exiting, then you might be cautious. So, but you might not want to buy it under yourself, because now you are already privy to that information. So, you can get X or Y or Z to buy shares in that company. So, that sort of information and leaking that information is insider trading. So, any information, it need not be something of this nature. It can be any fact which affects the share price of the market, disclosed when you are required not to disclose, can be that, and then you get a benefit out of that information.
And you mentioned about what really happens, and you mentioned something called splits. What is share splits?
So, a share split is where, so hypothetically, Ishan, say you own shares in a SP, S&P top 20 company in this country. So, you own 100 shares. So, the company can decide now over a period of time the share can go up in price. So, say the share was initially issued at 10 rupees and now the share has gone up to 1000 rupees. So, the share is trading in the market at 1000 rupees. So, the company can decide that let us make a decision that the share, that for one single share we would offer 5 more shares to each shareholder. So, basically what happens is if you own 1 share you will get 5 more. So, then your whole holding becomes 6. So, you are enhanced with the number of shares. So, that sort of information generally affects the share price, because the volume of shares are going to go up after the split. So, a split generally is decided at board level by the directors of a company, and then immediately pursuant to decision of that nature, that has to be disclosed to the market. So, that disclosure happens, and then once the disclosure happens, the share price would adjust to the price of the split, that is in a normal market. So, this 1000 rupee share, if it is given at it is split by 5, so you will get 6 shares, and that means after the split happens, the split does not happen, the board can't decide today morning that it is going to split the shares tomorrow, and from day after the share is going to be 1/6 the value. That does not happen. Dates will be announced, and ultimately that has to be taken to the shareholders have to approve it, all of those happen, and thereafter at a certain rate the share trading will stop, a split date will be given. So, for about 5 days those shares will not trade in the market. Then once it comes back to the market, it will adjust to the price. So, the 1000 rupee share might start trading at about 120 rupees. So, you might wonder, has my wealth of 1000 rupee share now dropped to 120 or 150? No, but you have to multiply that by 6-fold, because you have got more number of shares through this split. So, the basis of split is to increase the volume of shares which is in the float for people to buy.
And if you explain, Nishan, because I think anyone out there would understand, a 10 rupee share that is trading at 1000 rupees would be split into 5, which probably be after 5 days start trading at maybe 150 rupees.
Or it can be 200 even.
It could be 200 rupees, but eventually the goal is for that to reach a higher figure than the 1000 rupees in the end.
It might not come back to 1000 rupees immediately, but if it goes to 300 rupees, because generally splits are given by companies which have been doing well. So, they will decide to split their shares. So, then once it drops down to a lower target price or a ticket price, the entry price to buy a share, it might even attract more people to buy a smaller share in smaller value. So, more people will want, the enthusiasm might interest, the company will do well again, and from 200 it might come slowly to 300. Then you will make significant gains. So, your initial 1000 rupee investment might now be 5 into 300, that is 1500. So, that can happen. That is the net result of a split generally.
So, that is another part of what has happened. We have seen certain splits that has taken place in Sri Lanka over the last couple of months or so. So, that is to know as to what really happens in the stock market, and why certain companies do so is to attract new investors to come into the market and start buying these split shares. So, Beyond that, moving on from the same topic, Nishan, what sort of assurances does the regulators give the investors?
Well, the regulator is, as I told you the last time also, Ishan, it's the watchdog. It looks after monitors, insurers, brokers, also conducting themselves according to the license regulation, because each broker to trade in the market, they have to be a broker to act as a broker is given a license. It's like a finance company being given a finance license. So, that brokering license is renewed on a yearly basis. Now, the stockbrokers are also required to ensure that they do not lend to a certain client and allow them to buy at on credit. So, sometimes the broker, so hypothetically Ishan, your portfolio is 50 million rupees, the broker might allow you to buy for another 25 million rupees without you bringing in the required money at T plus 3. So, you do not bring 25 million rupees, you buy it and you hold it for about 4-5 days in a market where shares are going up on a daily basis, that will be good. So, then you buy it, in 4 days, 5 days it goes up in price, you immediately exit, you have cleared your credit. So, but now the SEC and the regulators are worried about it, and they are making regulations on that to tell brokers that you have to minimalize credit, because ultimately credit is does not entail that there is actual infusion of money is coming into the market. So, those sort of regulations are done and brokers are continuously monitored. A recent circular was issued to all brokers to disclose to the regulator on the amount of credits they have given to customers as at certain dates. So, not that they ought to have cut it down, but they were required to publish a report. So, they are doing that at the moment. So, some say the market is now reacting to that. The market is a little down these days because people cannot now trade on credit, and people who have bought on credit have to sell. So, ideally you have to, if you are going into the stock market to invest, my take about it is you have to be able to take that excess cash which you do not require to live on a day to day basis, because if there are fluctuations in the market, then that does not mean that you need to liquidate and take monies out of the market on with a loss. You can still wait till the market recovers. So, everything, there are ups and downs in life, there is ups and downs even in the stock market. So, you have to be able to withstand that, and people who have withstood that have actually grown in their capital gains, and that is seen globally and even in Sri Lanka.
So, what Nishan just explained is what they call a short in stock markets, where you actually take the broker lends you the money that you can go and buy, which you actually do not have, and trade for a few days. That kind of thing do happen. But in the case of funds, Nishan, can an investor who's got a certain amount of shares borrow on those shares?
Yes. So, now all major leading banks afford that opportunity, and that is called a margin trading facility. So, if you have shares, you can pledge those shares to the financier, the bank, and the bank can give you 50% or 40% depending on the rating given to that share. If the share is on the top 20, the index, they will give you 50%, or if it is not, it can decide to give you 40 or 30% capacity against the share. So, once a margin trading account is basically a tripartite agreement. So, it will be a account with the bank, you and your stockbroker. So, all three people will be part of this margin trading account, margin trading agreement. So, the shares you buy go into the margin trading account, and that account is called the slash account, and that is jointly owned with the bank. So, it is like your vehicle lease. So, if you have leasehold car, you have absolute owner and a registered owner. Likewise, shares go into a slash account. So, in the slash account, what happens is against the shares, so say hypothetically you have brought in 20 million rupees and you have bought shares for 20 million rupees, the bank will give you against the shares in the slash account the power to buy another quantum of shares equal to about 10 million rupees. So, you buy that against that. So, you are generating cash from security pledged on your shares. You are buying, it is like the situation where the broker also gives you that, but here actually a financial institute is giving you that. So, you are buying it in the margin account, and the interest rates are right now at about 9% or 8%, the standard borrowing rates in the country. So, it is not a significant amount. So, if you are a real investor, you can do that. You can expand on your portfolio. It is termed the portfolio, the entire share number you have in different companies is termed your portfolio. So, you can enhance your portfolio over a period of time by getting further buying power through margin accounts. But the downside, Ishan, in that is, in a market at this juncture when I am speaking, the market is down. Today it is down. In a situation like that, if the share price drops, then technically the security the bank has also drops, because the security is against the share value. So, when it starts dropping, the bank then might compel you, the borrower, to bring in cash to cover the deficit of the drop, or the bank has the power to immediately call the broker and tell the broker to sell shares. So, when you sell shares, it is money which comes in. So, then money comes to the slash account and the bank is happy. So, you can't pull money out of the slash account without the consent of the bank. So, that is the risk in a market which is volatile, the market which might come down. That sort of a facility might get you into a situation of a margin call where you might have to start selling shares at a loss. But if the market is going down, up, there is no issue at all. Every day your margin capacity enhances because the share value, their security goes up.
And that's a valid point, Nishan. I think a lot of people needs to know as to what to do and how to trade and all of that. But I'm going a little off the box here with this question. Is there provision for companies who are listed in the stock exchange to move out and become a private liability?
I think you can do that. You can, but the objective of doing, strictly speaking, the procedure of doing that is something which I have not personally come across of a situation where a company which is listed wants to now become a private company. You do your O-levels and you do your A-levels, and after you do your A-levels, you don't want to come back and do your O-levels. So, that sort of a situation is generally perceived. The thing is, there is the issue arises at that instance is if a company, because company has already drawn in investments from the members of the general public. So, there is the only way it can then retract or become smaller possibly is by winding up. They will have to go into insolvency. There have been public quoted companies which have gone insolvent, because you have taken the step to become PLC. I don't think, I am not aware or possessed of, that is a good question. The first time I actually triggered to me also whether there can be, but I don't think the law provides for that.
And from that, Nishan, how many investors or how many shareholders can a company have? Because we talk about the numbers, can a particular person own one share of a particular company, or is there a minimum number of shares that you can own of a particular company, or how many shareholders can one company have? Is there any regulations or stipulated, say a company can only have 1,000 shareholders, or is there anything of that sort in the legislation?
The decision is when a company decides to list and start trading in the market, the decision is where the company is required to decide on the number of shares it issues, not the number of persons who are holding the shares. So, you decide that this is the number of shares you are issuing, and accordingly, and at which price it is going to be issued. Then thereafter, one person, even if at one given time you can see people buying big stakes in certain companies. So, then they will buy volumes from a lot of people, and then thereafter the number of personnel would reduce. So, there is no limitation, there is no, in a listed company there is no requirement that There in person that there has to be this number or it can't exceed this number. But the shares which are issued in the company, so you will see certain companies which have a big float. You will say that that company is very liquid, and it's very difficult for a company like that to go up in share price because the volumes are high. These are terms brokers might use. But on the contrary, if a share company has less number of shares issued to the public, the ability of that share to increase in price might be more because there are only the float is less, but all can be purchased by one person. But in an instance where the company's shareholding changes over and above a certain threshold, so say hypothetically you want to buy 30% of a listed company. If you buy 30% of a listed company, you effectively take control of the company. So in terms of the SEC regulations, the SEC Act, there is also a code called the Takeovers and Mergers Code. So the Takeovers and Mergers Code then requires the person who sought to buy those shares to and the company to give notice to the world at large that somebody is now acquired 30% of the company. So in such a situation, if you buy 30%, you are required in terms of the law to give a mandatory offer to everyone of that company to buy everyone's share at a share price determined depending on the last few months of trading.
Prices.
So that is called a mandatory offer. So that's also now you will appreciate, Ishan. So in a situation like that, the entire company even can be bought over by one person. So if he gives a mandatory offer to everybody in the company, and everybody in the company decides that no, okay, I'm going to sell and get out, I don't like this party running the company, then he might become the exclusive owner. Right. So that sort of situation is also covered under Takeovers and Mergers Code.
So that's a very important subject that a lot of people needs to know, because this has happened over the years, Nishan. We've seen some of the large companies, so family-owned companies and all of that, that has been taken over by individuals or certain other companies thanks to this kind of thing, and thanks to the mandatory offering that all the other shareholders get, where you all of a sudden become the largest shareholder. Maybe you have more than 50% of the shares. With that, it's time for us to wind off today's edition of Law and Order. We spoke at length with regards to what really happens in the share market, what insider trading and what really goes on, and the kind of assurances that the regulators provide for the investors. And I'd like to thank Nishan Sidney Premitratna for sharing his expertise.
Thank you very much,
and taking time to be being with us on the show and sharing the knowledge that he has got. And it's time for me to say goodbyes on today's edition. We'll see you same time, same place next week as well. It's bye-bye from me.